Hey everybody, welcome back to We Talk Money. I'm your host, Chris Dunn. I'm joined by Nikki, certified financial planner, and Travis, hedge fund investor pro. And what a weird week. You know, some sad things happening, some controversial things happening. What's happening?
Well, you've got society reopening again, so that means the return of conflict and controversy, as always.
Absolutely. Got some, Goldman coming out saying some ridiculous things about Bitcoin. Obviously, the situation in Minneapolis is really sad. We've got, democracy in Hong Kong just getting steamrolled by the CCP. Why don't we just jump into markets?
Yeah, good thing this isn't a political show.
Yeah. Yeah.
Let's talk money.
Let's talk money. So the first thing I guess we could just jump right into is Goldman's report that came out. And I guess this was a call for their private investment clients. And I don't know. This is very interesting. A lot of controversy around this because while a lot of this information felt very fact-based and very objective, as soon as they started talking about Bitcoin, it was very obvious their bias against Bitcoin. What do you guys make of this?
Yeah, whoever created this report, had an agenda, clearly. Like if you show the Bitcoin slides like you were talking about, things like calling out one day that Bitcoin was down significantly and using that as justification why, it shouldn't be owned by private clients.
Yeah, and then it doesn't generate cash flow. Another point that...
Yeah, it's like, okay, yes, it does not generate cash flow like bonds or stocks. And hey, I get it. I'm a stock guy. I love stocks and I think they're great assets. But, the whole point of Bitcoin and some of these other assets is to not be like stocks and bonds.
Yeah.
So they're sort of missing the point here. And also it's funny because you could go back and look at 1987 when the entire stock market fell 23% in one day.
Yeah.
And make that a case against stocks. But clearly stocks have risen over time. So
yeah,
silly.
Yeah, that feels like cherry picking.
Yes, saying that Bitcoin is not an asset class because it doesn't operate like stocks and bonds is like saying that boats don't have any value because they don't fly. Right? Yeah. They're just different.
Yeah, exactly. Yeah, I mean, there's plenty of other asset classes beyond stocks and bonds that can generate growth over time. We've seen things, even things like cars or art, those are strange assets, but they've appreciated over time.
If it has value and you can sell it for something and potentially sell it for more than what you bought it for, technically it's an asset on the balance sheet, right?
There you go.
So Bitcoin's obviously holding some store of value. It has been for years now.
Absolutely. And I think this is kind of funny, obviously for us that have been in crypto for a long time, we know that a lot of people always like to point out the fact that cryptocurrency can be a conduit for illegal activity. Yeah, and so can the US dollar.
Yeah.
In fact, criminals prefer cash.
Yes, cash is worse.
Yeah. So, I get it. They're trying to point out a lot of the risks associated with crypto, which I think is important. And look, they would not have put this in there. Who is the client that is typically getting this call? Trav, you're a former Goldman guy.
Yeah. So I believe this is Goldman's PWM division, their private wealth management division. So typically they're servicing clients with like 5 million of net worth or higher. And, that's a pretty wide range of individuals across the globe. So,
yeah.
But they have tend to be a little bit more conservative in some of their approach. Now, their goal is to obviously help their clients grow wealth over time. And Goldman does have ways to, put them into assets like, private investments and things like that can be pretty interesting. So I'm surprised actually to see them taking such a hard line against an asset class that clearly has grown in value over the last few years. It's strange to me that they wouldn't approach this with more of an open mind.
Yeah. If I'm guessing, and again, this is just a stab in the dark, it seems like they wouldn't have this in there if people weren't bringing it up, right? Like imagine in the real world, they probably got clients calling them like, hey, why am I not holding any Bitcoin? What is this Bitcoin thing? Yeah. And so this is their official stance, which is probably like a CYA, like they're covering their ass talking about all the risks associated with it, which is true. It's very, very volatile. It's probably not right for everybody, but to just say that it's not an asset class and that, they were even like shitting on gold up here and talking about how stocks were really just such a better investment, which I get, but it just seems like a very biased report. everything prior to this, talking about the economy, was very objective and very fact-based. But once they got down to the investment, it's like you can definitely clearly see the bias of them trying to push equities.
I think it's strange too, because like I said, these clients typically have pretty high net worth. And so for them to have a small allocation would seem to make sense. It's not like Goldman here is dealing with people that, you know, don't have grocery money or gambling their money on Bitcoin to try to double their money in a month, right? Like, these are people that have the assets that should be able to invest at least some allocation in Bitcoin for a long time frame.
Yeah. I would be surprised if these guys weren't sitting back privately buying it, like the wealth managers. I mean, why wouldn't they be?
Oh, absolutely. I guarantee you that there's a significant portion of Goldman employees that own at least some cryptocurrency. I know that for a fact, actually.
Awesome.
Well, there you go. You heard it first.
But I guess, you know, it is different for Goldman to put something that's public facing out there for the private wealth clients than for Goldman employees. You know, they tend to be a little bit more aggressive with their risk tolerance. So
It does feel like a cover your ass type of thing to me.
Yeah. Just pointing out the risks.
Yeah.
Yeah.
Because if they put their clients in Bitcoin and then, you know, something happens and it's them, they're on the hook there.
Yeah.
They have to basically, you know, have their clients' best interest in mind. And a lot of advisors and planners are basically saying, hey, this may not, you know, work because it's too volatile. So they just don't even put it in the portfolio.
Yeah.
But yeah, like we've talked about many times, there's many people, especially younger demographics, that are interested in having an allocation of some kind to cryptocurrency.
Yeah. Well, I mean, look, we need somebody to buy at higher prices. So maybe these are the wealthy people that can actually drive it even further.
that's probably likely. You'll probably see a lot of these clients, maybe even Goldman themselves, in their private wealth division, flipping their stance when Bitcoin's at 25 or 50K. You know?
Yeah. Be like, actually, we were wrong. The volatility's gone down a little bit.
Yeah. It's just surprising to me too, because Goldman is opportunistic typically, and they're gonna go where there's money to be made. Now the private wealth division does tend to be a little bit more buttoned up and conservative, so maybe that's just a reflection of this particular part of their business.
Interesting. Why don't we talk a little bit about the economies opening up and things like, you know, travel and the stock market bifurcations that we're seeing, and, you know, just the confusion that people have. Like, what do you mean the stock market's back at almost all-time highs? What do you guys see there?
I mean, I think my personal opinion is it's a combination of the stimulus that we've seen. I mean, we saw monster stimulus, not only from the fiscal side, but obviously the monetary side, the Fed as well. So that helped, apparently. And the economic data is kind of showing that households may have gotten some of that stimulus, which was
They
the
actually
intention.
got a benefit.
Yeah. Also, I think the market is just being crazy forward looking. And then the third thing is we've got big tech kind of holding things up.
Yeah, this was a really interesting chart that one of Travis's friends was retweeting today, which was just showing like the difference in, so you've got I guess we went from FAANG stocks to FAAANM.
Ridiculous, by the way. Like, these acronyms are just getting out of control.
Yeah, so Facebook, Apple, it's no longer Google, it's Alphabet, Amazon, Netflix, and Microsoft. So, you know, you take these half a dozen stocks and you compare their performance compared to everything else, and it looks like a totally different stock market.
Yes.
They're in a league of their own. What do you make of this, Trav?
Yeah, we pointed this out, I think, in a couple of recent shows and in my Stock Geek newsletter, that they account for 25% of the S&P 500 in terms of market cap, but they actually account for an even greater percentage of the outperformance of that index versus other world equity indices.
Yeah.
So very, very interesting to see that. Not too surprising. But, you know, it's a big reason why a lot of people, I think, misunderstand what is really happening under the surface in the markets.
Yeah.
Now, that being said, we did see, I called this green shoots rally about 2 weeks ago, because I said, hey, as things open back up, we're going to get a lot of positive data coming out in terms of the, you know, not the overall numbers versus last year, but the rate of change is going to improve in things like air travel numbers, in terms of people going back to work. Spending should pick up a little bit. Restaurants are obviously going to see a recovery. So that is actually working. And a lot of those stocks, the market did rotate over the last 2 weeks into some of those beaten up sectors like airlines and travel and banks, financials. Yeah. So even retail got a little bit of love in certain stocks. So, that actually is, I think, a big reason why the market has continued to go higher, even as, tech valuations look pretty stretched. Now that rotation into some of the other sectors is helping the market go
nice.
higher.
And there's still room to go in a lot of those beaten down sectors that could, help too.
Yeah. What do you guys see as like the most beat up sector, or maybe one that has the biggest upside right now?
I mean, travel's just been beat to shit.
Yeah.
Travel and financials, I feel, have just been creamed.
Yeah, I think financials, travel, and retail are the three. Energy actually has rallied quite a bit. I would say that would have been up there, but it's rallied quite a bit with oil prices over the last couple of weeks. But yeah, I think brick and mortar retail is one of the areas, and financials, given where interest rates are, still not very loved by a lot of the market.
Yeah. One thing I know you've been paying close attention to, Trav, is the TSA Travel or traveler data, like the number of travelers. What have you been focusing on here?
Yeah, so I've just been tabulating the data of the daily traveler numbers in the U.S. for air travel, which comes from the TSA, like you said. And, we were seeing, as of 2 or 3 weeks ago, the numbers start to inflect up. And you can see the overall numbers. We're still at only 13% of the year ago numbers, but the week over week growth and the 7-day average growth numbers have been 20 to 30% plus for the last 2 weeks. And so it just gets better and better. May have flatlined a little bit the last couple of days. We'll have to see how that shakes out over the next week or two.
Yeah.
These numbers still need to go a lot higher for the airlines and the travel sector to be healthy. So
we're basically seeing only about 10 to 15% of the last year's travelers that are currently traveling.
That's right. Yeah. And that's up from, 6 or 7% 3 weeks ago. But so the trend is good, but the overall numbers still are quite depressed.
Yeah.
So it's really about, if those numbers do start to flatten out or roll over, I think that's going to provide a headwind for the travel sector again. But right now it's looking pretty good. Airline stocks rallied quite a bit over the last 2 weeks.
Yeah, what were some of the bigger ones? I guess like Delta,
DAL. Southwest. Pretty much anyone. Spirit Airlines. Any of the big ones rallied quite a bit.
Yeah, a lot of these were down 60-70% or so.
Yeah,
pretty interesting. So. What are you guys thinking in the short to medium term? Are you still net buyers? Are you holding? Are you going short? What are you thinking?
It's kind of amazing because actually this week my portfolio ticked up for the year. So I'm now up year to date, it feels weird. and like, obviously I'm happy about that. And it's made quite a big recovery from March. And, we made some good aggressive buys near the lows, but it feels weird.
Yeah.
But the reaction is typically to then go to cash or go flat or put hedges on, and I do have some small hedges on, but I also want to let some of the stuff that I think is still undervalued work and see how things play out over the next month or two. I do think there could be an interesting opportunity to get short some stocks or short some market hedges at maybe the early to mid-July timeframe, with a confluence of factors kind of coming together, having a little bit lower volatility, the market having rallied. As we approach Q2 reporting season, I think the earnings for Q2 are going to look a lot worse than a lot of people expect for some companies. And, there could be some complacency. We get closer to the elections. There's just a lot of weird risk things, potentially more shutdowns from the virus if we get a second waves.
Plus the fact that we've seen this crazy V bottom in the market. I mean, this is going to eventually have to cool off at some point, right?
Yeah.
I mean, not to say it has to. I shouldn't say that. But, with a move like that, and if it continues higher from here without a significant correction, ultimately, eventually, it'll come from somewhere.
Yeah.
So
I think we talked about this over the past few shows. I've been entertaining the idea of putting on a direct short hedge, kind of like you were doing, Travis. And I was looking at this 61% retracement on the S&P 500. The problem that I saw was it seemed like a very crowded trade. There were a lot of people showing the same chart over the past couple of weeks, and anytime I see there's a lot of agreement and confluence between big, stock guys, I kind of get a little bit like, okay, why could this not work, or how could the market squeeze this? And I've
been screaming this for like a month now.
Yeah.
It's like
Well, yeah. What's your read on it? What's your opinion on
my read
this
was exactly that. It was a crowded trade. Everybody was on the same side of sentiment. And when that happens, usually stuff like this happens. At least from what I've seen being in the market for the time I've been in.
Yeah.
Granted, I'm not saying that the market is not expensive or, it depends how you look at it, right? But obviously, I think the market could use a cool-off session here.
Yeah.
But when you look at price action has been strong for a while now, and everybody was on the same side. Everybody was saying, no way we're going higher from here.
Yeah.
And when
Wall Street Bets puts it all-time highs.
Everyone's YOLOing short, and it's like, guys, it doesn't have to do that. And it felt crowded to me.
Yeah. Yeah. One thing I've been thinking about recently is the Peter Lynch quote, which is more money has been lost in people trying to anticipate market corrections than is actually lost in market corrections. So I'm thinking about this, like, as the market just keeps grinding higher, I'm like, yeah, there's a lot of people getting squeezed. And on the ES in particular, you can see, this week, the market did squeeze a lot of people that were shorting over the past month.
And I'm noticing people are still piling in short here.
Yeah.
I'm seeing it on Twitter. I'm seeing it, other people. And so it's got me thinking now, okay, now we could see it squeeze even more.
Yeah.
And then everyone's just losing their minds and doesn't know what to do anymore. And then that's when the rug gets pulled.
And maybe that'll line up with what you were saying fundamentally later in the summer.
Yeah.
We'll see. Timing this is really, really hard.
It's super hard.
Yeah.
It could roll over tomorrow. Tomorrow we could see 20%, correction. I don't know.
Yeah.
No one knows.
Well, tomorrow the markets are closed, but
sorry.
yeah.
Well,
no, next week, yeah, right.
yeah,
like going into the weekend, like who knows? Like,
yeah, anyone that's saying they know what's gonna happen doesn't.
Yeah. It's so hard. Well, you guys want to get into some Q&A?
Absolutely.
All right. We've got a couple of good questions talking about like strategy and timing. And David was asking, when entering a short-term or long-term trade, what should the stop be? Basically, like, how do you judge your stop percentage, lower or higher of the entry? Is there a formula? I have my opinion on this, which is it's different for every trade. So the question is basically like, how do you figure out where to put a stop?
Yeah.
My simple answer for that is, where should the market not go for your trade to still be intact, right? Like, I think putting like arbitrary percentage stop numbers isn't really effective. It's like, maybe if you have an algorithm and you're doing short-term trading and you figured out some kind of edge there, but like in general, if you're looking at a chart and you go, where should my stop be? What should be behind where the market should not go for that trade to be intact?
Right.
And that's going to be different on every single trade.
For me, I utilize like risk to reward. Okay, if I'm risking, X percent, I want to see 2 times that percent in reward for me to take the trade. So
you have like a minimum threshold.
I'm obviously looking at the chart and figuring out where the market should not go. That's like step 1. And then I'm like, okay, where's my reward from here? And is it worth it? And do I have enough reward for this risk, looking into where the trade should not go?
Right.
So, yeah.
Trav, how do you think of that?
I don't use hard stops very much because a lot of what I do is driven by fundamentals, and I'll typically keep tabs with the story of what's going on with the company and the stock so that I understand. The thesis typically is not broken because of a price level for me. It's typically broken because of some fundamental event. But I do pay attention because if the stock is doing something that I'm really confused about, it could be a signal that there's some fund or some event that people know about that I'm missing. So occasionally I will lighten up on a position if I feel like something's happening with price and I don't really understand why. So yeah, it's hard for me to answer this because certainly I don't have a formula and I don't use hard stops very much, but occasionally if I'm in a swing trade, which I do sometimes, I will, typically put in like a stop that's like 20 or 25% below, but that's based just kind of on that's basically the idea behind it is kind of similar, which is like if it's gone against me that much, there's probably something that's happened or that I'm not aware of that means I need to get out and rethink what I'm doing.
Yeah. So that's more of like just a worst case. Like if a surprise event happens, you're going to protect it. It's not so much like based on technical analysis.
Yeah, that's right. This actually, interestingly enough, we had a swing trade this week or the past 2 weeks on a company called Cumulus Media, CMLS. And so this was something that has been on my radar for 2 years, a company that I had been watching. It was prior to this, it was a restructured company. Actually, it had come out of bankruptcy. It had too much debt. It was private equity owned. Came back public after they reduced some of their debt. Still pretty heavily levered on the balance sheet. Third largest radio station owner in the U.S.
Oh, wow.
Sold off dramatically during the coronavirus crisis. It started to catch my eye in like April timeframe because it wasn't rallying with anything else. And
where it kind of flatlined here around $4.
Yeah, and it only had about a $50 to $60 million market cap. So there were probably not very many funds that could even get involved. So it was an interesting situation because I looked at the liquidity position and I thought, I think they'll be able to survive this period and then hopefully recover as the economy recovers and this stock can be a multi-bagger from this current point. But I started buying it in the high threes, and I told our investment community, I'm going to have a stop on this thing at around $3 a share. And it almost got there. At one point, I think it was like $3.05 a share.
Oh, wow.
At one point, about a week later, it had just continued to sell off. I didn't get out of the trade. I actually did more work on it and figured out that they're actually about to complete a land sale that's going to give them another $75 million of capital. And I said, this is really interesting. The setup on this is really interesting. I actually doubled my position. And then for whatever reason, this past week, it took off. I didn't see any specific news other than the company put in a poison pill to make sure there wasn't a takeover of the company at these low prices. But
nice little double in a week there.
Yeah. But it's one of those where, like, especially in a smaller illiquid stock, your stop may be a little bit larger because the volatility can be a lot wider on something like that.
But the reward is enough to justify, right, that percentage.
Yeah.
So, like, if you're going to risk 25% and that's where the market should not go, well, you want to at least be able to have enough reward to where it's worth taking that stock.
Yeah, absolutely. And that's how I think about it too, is like in Bitcoin, when it's really volatile, if I have to have a big stop on a percentage basis, you just kind of dial back the position sizing, right? So it's like, instead of 100% position, maybe you dial it back to 75 or 50% because you have that larger stop size.
Yeah. I mean, if you're trading Google on a daily or something like that, your stop is going to be much smaller in terms of percentages.
Yeah.
Because your upside is not nearly as high.
Yeah. Very interesting. So, I know you guys like to go dumpster diving, as Crypto Hustle calls it, when you get a stock that's like just really beat and it's maybe a little overly emotional to the downside. And that gives you that really favorable upside if it comes back to reality, right?
Yep. Absolutely. Yeah. This was so interesting because it was really, no one was paying attention to it. And I thought this was a pretty easy 100% gain plus potential within like a very short time frame, a month or two.
Nice.
But
very cool. Okay, so next question. O-Ticket asks, if there's a lump sum to be invested in the market and the market's falling, what are the strategies to use? So basically, if the market's crashing, like how can you buy outside of DCA, dollar cost averaging? How do you scale into a position? How do you guys think of this?
Well, for me, it depends a lot on what's going on, right? So if we're, like we saw in March, we saw a pretty big sell-off, pretty significant, to where you could have maybe put in a 50% of your capital and then saved the 50% left to, there's so many different ways you can do it. You can put it really depends on the person, what you're trying to accomplish, and so on and so forth. And you could have gone in half and left half in case we saw more of a sell-off. You could have gone in 80% and kept 20%, to deploy later. It's really tough to pinpoint exactly how somebody should do that.
Yeah. It's impossible to be perfect and to catch the bottom.
Yeah.
So I'm a fan of scaling in and thinking of in terms of, like splitting it up, like going in a quarter here, adding lower, and
it's a delicate dance, right? Because back in March when we saw that sell-off, it was just blood, right? You want to get the ideal situation there would have been get as much capital in as you can. So it's tough. And that's why we scale in. And when we see those big sell-offs, we're probably putting in more capital, a higher percentage of capital at that time, and then leaving a little bit left.
Yeah, that's right. Yeah, that's pretty much what I do on single stocks too. It's like I don't have a set formula for like averaging in every day or every week. I tend to weight it by how price is relative to my target.
Yeah.
So, if we're 50% below where I think the stock is, it might be 3 or 4% position. If if the stock is at a, 80 or 90% discount to where I think the fundamental value is, then maybe I'm at a 10 or 15% position, and I'm deploying aggressively. So it really is a lot of times dictated by how deep the price movement is.
Yeah.
How quickly it's selling off, things like that.
And then ask like, okay, what is like the worst case scenario of a dip here? And like, how could I scale in a way where I'm not going to capitulate and actually freak out and sell the low?
Well, this is where the fundamentals, like knowing the fundamentals, come in super handy too, right? Because if you know you're getting good value, you're like, okay, I'm going 80% of my capital into this stock. Like I'm sizing in, So it really helps to justify how to position yourself into it.
Yeah. Awesome.
Like when the market was selling off in March, I was thinking about the fundamental side of, what are earnings going to look like? Okay, let me run some numbers and compare it to 2008. Okay, I think we're at a good place here, fundamentally. And that helps a lot, I think.
It's a great point. Like if you're looking at just making like an ETF based investment, like broad market exposure, you could use a guide like, the earnings yield of the S&P versus interest rates, or, the PE ratio versus its historical median and things like that to either be more aggressive or less aggressive in investing in the index.
Nice. Yeah, there's so many different ways to approach it. Next question. Christian says, where can I find financial information, like financial statements about listed companies? Trav, this is your ballpark.
Yeah, we were actually talking about this week in the Stock Bootcamp course. So there's a number of different places you can find that info. Obviously, U.S. companies, for instance, file their financial statements with the SEC, and the SEC has the SEC Edgar website where you can literally go type in a company name or ticker, and that'll bring up all their history of filings, including their financial statements. Now, you also have sites that are free like Yahoo Finance or Koifin, which is one of my favorites, where you can look up this information in a nice user interface, and you don't have to go into those long SEC filings necessarily, and you can see a lot of that financial information in a snapshot, which I think is really helpful.
Nice. We can link all that up in the show notes as well.
There are other paid products too. Like I use a product called BAM SEC, which is about $35 or $40 a month, and it has a really, really great interface for accessing different filings, and it categorizes them and has a bunch of other stuff too.
Nice.
Investor relations websites.
Yeah, that's right.
Those are great places to go if you have a specific stock in mind. Every public company has an investor relations website. Just Google company investor relations. You can find all their filings, everything, press releases,
news. Sometimes investor presentations. Yeah.
Awesome. Next question. Badgery. Which platform would you recommend for day trading for New Yorkers?
Why New Yorkers specifically?
Yeah. Well, in New York, you see, we have a special way of doing things. Well, I mean, day trading, I think we've talked quite a bit about day trading on the show and how maybe in today's market is probably not the best approach. The competitive landscape just really isn't there. That's my personal opinion. But
if you're going to do it.
Yeah, if you're going to do it.
The platforms to do it would be things like Interactive Brokers, Thinkorswim, TradeStation.
There's several
major ones.
Yeah, and look, there's several trading platforms out there. On the future side, you've got like NinjaTrader and stuff like that. On the crypto side, you're really just going directly to the exchanges. So it depends on which market. But in general, I would just say, like, why are you day trading? and maybe is there a different approach that might be better suited for your goals? We've covered the data in the show where we talk about how pretty much all day traders eventually lose money, and the ones that do make money, really, it's not significant. And again, that's changed over time, right? Like it used to be super profitable back in the late 90s to go in and be a scalper when stocks were on the fraction system. And then, as the algos started to take over, the shorter time frames get more and more competitive, and it's like a race to the bottom. And you've got the Jim Simons of the world, the best hedge fund ever, who's employs mathematicians and PhDs. And like, my question is, can you compete with that? Right? If so, like how? Like, what's your edge?
Yeah.
So yeah, on that note, again, really crazy volatile week as far as just the economy opening back up. Obviously there's a lot of really weird stuff happening. Liberties are being challenged. I think this is the theme for 2020 is this is Bitcoin's time to show what it can do. Like if it can't succeed under these conditions, like that, this is the time that it really needs to show.
Yeah.
We need everything to just succeed under these conditions. And spread love.
Yes. Positivity. Let's help each other.
Spread love. Let's try to unite.
Yes. It's so divisive.
Yeah.
And on that note,
well, thanks for watching, guys. We will be back next week with another market update and more questions. So if you have a question for the show, go to wetalkmoney.com, submit it there. Don't forget to subscribe to the podcast. We'll link that up in the show notes. And see you guys next week.
bye-bye.
Take care.
See ya.